edition of got the privileged opportunity to have Aaron Yassin on, and I've got an introduction prepared for him. So I'm going to look over to my screen to read it to you guys. He is a design-driven developer building ground-up construction apartments in Brooklyn, New York. He's got 20 plus years in real estate, design, and fine art. Aaron brings a unique perspective to the development world. He's worked with renowned architects, artists, and designers, and even won a prestigious Architizer A+ award. I hope I said that right. In 2021, Aaron co-founded Hive Developers with the highly respected Tal Block. I probably should have checked how to pronounce his name. They're on a mission to share their knowledge and expertise, helping investors grow their wealth through their unique proposition. Design drives value. All right. So without any further ado, let's bring on Aaron. Hey, Aaron, how are you?
I'm doing great. Thanks for having me on, Mark. And
absolutely.
Thank you too, Matt. Great to be here.
Yeah. So we usually get started just by kind of asking how you got into real estate investment. You know, most of us come from like kind of like a W-2 and do like a little transition into real estate investing. I know you've got the real estate backbone. So what did that look like when you went from, earning W-2 income or 1099 income and then translating into more of a active or passive investor?
So there's a little there's kind of a ball to the answer. It's not exactly a straight line because I've done different things in the past. Actually, one of the first jobs that I had as a teenager was working for a general contractor. I grew up in Indianapolis, Indiana, and so I worked for a general contractor there. But the specific entrance into real estate is very interesting, actually. So I moved to New York after graduate school. And I was looking over in Jersey City for a rental apartment, and this was it was a number of years ago. Let's just put it that way. And at the time, the New York market was fascinating because I was living in Brooklyn at the time, and I was actually already looking around at some real estate. So maybe part of that was encouragement from my father, whose father, my grandfather, had a number of multifamily buildings in the Boston area. So I was over in Jersey City looking for apartments, and over there in New Jersey, they have what's called an MLS. Now everything's online, but back then it was a little paper printed magazine, and it didn't exist in New York. Everything in the city was kind of a pocket listing. You never knew what was what. So I'm sitting waiting for a broker to go look at an apartment to rent, and there's a stack of these MLS right next to me, and I flipped through it and started looking at it, and I was just absolutely amazed at how cheap, inexpensive some of the apartments were that were the same type of apartment, but actually much better apartments than I was looking to rent. And I said, hey, let's look at these apartments to buy. And I looked at a couple, and I just I'm typically able to make a decision fairly quickly. So I looked at a couple, and I made an offer on one at the full asking price, and it was accepted, and it ended up costing the same or less as I would have spent to rent an apartment at that time. So that was my first purchase. And then from there, actually very shortly after that, I had moved into a studio space. I had my artist studio in Jersey City, and the owners of the building came to me and said, we're thinking about selling the building. So I thought, well, I've moved my studio in here. I'd kind of like to stay. Maybe I'll buy it from you. And that actually worked out. So that was my first multifamily.
Very cool. So your studio was for like arts, or what were you doing in the studio?
Yeah, it was a fine art studio. But the building had 3 rental apartments, residential apartments above the studio space. It was a commercial space in the building.
Oh, very cool.
So that was how, and the building was actually pretty good cash flow. And so I had it for a while, and I actually then subsequently sold it and did a 1031 exchange with that investment. So there was a little bit of a snowballing that happened at that point. So, and at the time I was working as well, and had variously W-2 jobs or 1099, doing different things. A lot of artists figure out what they can do, and sometimes it's full-time, sometimes it's part-time. There's generally a somewhat of an entrepreneurial spirit because you want to get your work out into the world and sell it, basically.
Yeah. So cool.
So there's a little DNA built into it if you want to keep exhibiting.
So, Aaron, what are you up to these days?
So right now, I'm as Mark mentioned at the beginning, I've partnered with a well-known contractor here in Brooklyn, and we're focused on we founded the Hive Developers, who's on right behind me, and we're focused on doing ground-up condominium development here in Brooklyn. So we have 2 projects underway. One is an 8-unit building that will be a little under 7,000 square feet when it's completed. And then there's a second project that's 10 units, although it's not that many more units. The units are on average larger, and that building will be about 13,000 square feet when it's completed. So we have those 2 in process at the moment. So that's what we're focused on.
Sweet. So one thing is a hot topic I saw on your bio, 421A. For us people that don't understand what that is, and I've only been made aware of it because I have a friend whose name is Alvin Sheen, and he works in the real estate development space as an attorney in New York City, and he's been talking a lot about this on LinkedIn. So can you kind of give us some flavor on 421A and it's kind of
interesting? Yes. I think when I mentioned that, a lot of people that aren't in New York don't know what it is, and there's a lot of intricacies, to the New York real estate market that definitely can create a barrier for entry for a lot of people. And that one sounds particularly jargonistic, right? Like what in the world is a 421A? So there, essentially, the 421A it's a tax abatement program, and it's existed in various forms for decades. And those forms have taken, they varied from, build something or develop something in a certain location and you get a tax abatement. Could be 10 years, 15, and they have gone up all the way to 35 years. And typically what you get from an abatement standpoint is that the taxes are they are set at the rate of the taxes when you start the project. So the building is not reassessed based on the construction cost for the building. The last 421A that existed, because it ended last year at the end of June. So there's currently no 421A available, but the last one required 30% affordability in the projects. And although there was a possibility to take advantage of it with a for sale condominium for sale project, there were some high bars in executing that, and it was fairly rare. But that 421A with the tax abatement for affordability definitely drove a lot of development of rental units, and it made those projects actually pencil out pretty well if you could find the right site. And now that it's gone, that's really impacting rental development in the city. So these things are really, they play a pivotal role in what actually gets built. And I think it's actually unfortunate that it wasn't continued in some form. My expectation is that it's an Albany question. So you guys are both in New York State also. So they decide the 421 in Albany as well. And nothing moved forward this year. And actually, the budget that was just passed, there was a goal to extend the completion deadline for projects that had started, and they didn't even do that. So there's some projects that are in jeopardy, significant jeopardy, if they're not completed on time.
Yeah, no, it's unbelievable. Yeah, because I'm like, how is that like congruent with the governor's plan to create, what is it, 800,000 housing units in 10 years? Was
it that many?
Is it 80,000 or 800,000? Let's 10x it. Let's make it 8 million.
800,000. Well, unfortunately, nothing really happened on housing, and it's I mean, from the reporting that I read, it's going to create a dent in the economy in the state. That nothing was passed. So hopefully that can be brought up again. I mean, I'm hopeful. Hopefully, more politicians. There's a lot of progressive politicians that have certain positions on real estate. Hopefully there's enough that will understand, the value that new construction or renovation brings. And there can be some agreement on how to move forward, because there's absolutely a requirement, a public-private partnership requirement for housing all across the country. It's not just in New York.
Yeah, 100%. Thanks.
So it looks like we do have a question in the comments from Kyle. He said, let's talk about CPACE financing for clean business infrastructure upgrades and new builds. That's beyond me. CPACE?
CPACE, it's definitely something that I'm looking into, but at this point, I don't feel like I'm expert enough to have a good discussion about it. The CPACE, it's a lending program that's tied to meeting certain metrics of sustainability for development projects. So there's actually a lending program that's tied to it. The rollout I was looking into this for the projects I'm working on. The rollout in New York has been, it's not as far along as it is in some other places. So there's some other states. It seems like it's kind of state by state based on, regulatory components. So, it's not something that I would be able to take advantage of for my project. So I'm looking forward to learning more about CPACE financing, and I'm hopeful that it will actually be something that I can implement in future projects. But it's tied to certain sustainability and environmental initiatives for new construction.
Is that like if you get LEED certified or something?
No, you don't need to it doesn't need to go that far. There's just metrics that you need to meet. And I think that there can be some tiers also depending on how the program is developed. But it's a specific type of financing that is definitely advantageous if you can get the program to work. So that's partly why I was looking into it. And again, this is the same kind of public-private partnership that's really essential to getting more housing built. So something I'm definitely going to continue to look more into, but not currently an expert enough to discuss it fluently in this forum.
Yeah,
but it's a very good question. So maybe we can revisit that in another LinkedIn Live.
Yeah, absolutely. My father sent me an interesting text yesterday. He's down in Pennsylvania. He sent me a text that I don't know what the source is, but he's saying in a landmark decision, New York has become the first state in the U.S. to pass legislation that prohibits the use of natural gas and other fossil fuels in the majority of new buildings.
Which I think is great. The two projects that I'm working on, we already decided that they would be all electric prior to this passing. It's definitely, I think it's absolutely better not to have any fossil fuels in the building. They're not necessary in any way whatsoever. And that way, if the building is all electric, then, as soon as the grid is properly upgraded to allow for more sustainable energy, then you can use that for your building. I mean, there's already some options out there. You can pick energy suppliers, and this will allow everyone in the building to take advantage of that. It's also, there's some danger with gas. So, I mean, you typically,
yeah, but I mean, cooking on electric versus cooking on gas, it's kind of disappointing.
Oh, Mark, have you used an induction? Have you used an induction stove before?
Exactly. You've just got to install induction stoves, and they actually heat up more quickly. They're much safer. If you have kids, they're not going to burn themselves or melt their skin. So it's much safer. You don't burn things on them. And it's an interesting question, because there was a survey that I read about this also. Currently, I think it's something less than 3% of households have induction cooktops. But when people were asked about it, 70% of the people that were surveyed were interested in finding out more or actually having induction cooktops. So well over 50%. So I don't think there's a real barrier, a barrier to entry to bring that type of fixture into new construction. And there's not an issue with other types of appliances, in new construction either.
What about commercial What about commercial kitchens? Are they going to be forced to use electric
I
as
think
well?
it's going to be a slower process. There will definitely be more, more pushback on that from commercial kitchen operators. But I think for residential construction, there's no need for it. And I definitely applaud the state government for getting ahead of the curve and implementing that at this point, and already something that we've implemented on our projects. So
Right, but
we
we've got
definitely.
this. At least in New York isn't drilling horizontally, but Pennsylvania is, and so they've got so much gas beneath the surface. It's already ready to go, and it's piped over to New York City already. They're converting natural gas into electricity. So you're saying, okay, let's not have natural gas in the house, but let's use it to make the electricity that we're going to force you to use. Like, to me, everything is just seems a little backwards. I mean, I get the premise and I understand why they want to do it for like long term, but short term, if we've got this gas already, why shouldn't we take advantage of it?
Well, I mean, you've got to have some long-term thinking, right? How can we really, gradually move in the right direction to really address climate change? And if we don't start and make incremental changes, then we're really not going to address the problem. I mean, certainly energy is a big issue, and there's lots of needs that we have. It's not just that we use a lot of energy. It's also, it's strategic. I mean, this is a significant issue and a significant question. And we're not going to stop drilling anytime soon because we need the energy. But if we can gradually shift in the right direction over time, I think the shorter the time window, the better. But if we can start doing that sooner than later and have the ability to make the shift, of course, which will happen gradually, then we're going to be in a better place. So if buildings only have electric infrastructure, then they can take advantage of renewable energy just based on the grid. So, feed more renewable energy into the grid over time. And it's just a shift, well, I don't know what it's maybe 7, 8, 10, 15% now. If that can go up to 30%, that's a dramatic impact on the type of energy that's being supplied into the grid. But the grid itself needs a major upgrade to even get to that point. So there's a lot of things that need to happen, and you just got to, work on each one of them gradually. And then that's the way to get there. So, I definitely support, that kind of initiative, and I support the legislation on that one.
Yeah, absolutely, Mark. No more Bananas Foster, and Cherry's Jubilee, brother. So,
and I think actually this is, if I can kind of segue into it, I think thinking about these kinds of things is actually, of course, it's an infrastructure question, but it also connects to design questions. Because there's different ways of thinking about design, and one of the ways of thinking about design in architecture is to think about sustainability and energy efficiency. And having a house that's all electric, if it's built in the right way, is going to be a superior type of product that you can build. So it's just one of a number of things that will move architecture and architectural design in the right direction. And that's really dealing with the kind of, the systems design, the infrastructure design, and some of the mechanics of the building itself, as opposed to the aesthetic component of the building.
So no more outdoor fire pits, no more gas lanterns on the side of buildings, none of that. That's all going to be gone.
I mean, I don't think that's all going to be gone. If you're going to pipe it in, yes, that might be gone. But I think, you're more than welcome to actually have a real fire in your backyard if you're in the right location. Certainly you can't do that.
Yeah, but I mean,
here in Brooklyn.
you're right. Small spaces. It's nice to be able to just, turn on an outdoor fire setting that's hooked up to your natural gas supply. Or, if you go to some areas where they have those torches on the front of their establishments, it's a beautiful thing to see. I think they're pretty prevalent in New Orleans and some other cities. I've seen them, not quite as prevalent, but it's still kind of an architectural feature that we're going to lose.
Absolutely. And that, it's definitely connecting to, historical design elements in a certain location and space. And I would agree with you. There's certain questions there that we can ask and look at, how can we achieve, something similar. And I think in most cases, there's ways to do it.
Yeah, for sure.
So I wanted to ask you, I mean, kind of curious about how your passion for art kind of came about, and how you fused that with development and architecture. I'm just like curious about that passion. Obviously, I want to hear more about your first real estate investment that turned a 70x profit on it. But I kind of want to dig into that little touchy feely stuff first.
Okay, I'm gonna run through this as like personal bio stuff as quickly as possible. So I've always had a very natural inclination to make things. Since I was a young child, but I had an unusual level of exposure to fine art because my father was the director of the Indianapolis Museum of Art while I was growing up. So I was at the art museum all the time, and my dad basically had the keys. So a lot of people have some stigma with going to an art museum. There's this kind of thing. It's like the building up the steps and things like that. And I just went with the guy that had the keys and could open all the doors. And it made it. And there were lots of artists around also. So that exposure definitely it just put me in a world of people that were doing these kinds of things regularly, and so I had a little bit more connection, to the process and the profession essentially, and I just really continued to develop it. And then I went to art school for undergraduate school in Chicago at the School of the Art Institute, and while I was there, I worked for an industrial designer who went to school at IIT. There's a fantastic, for people that don't know, I'm sure a lot of people here are aware of it. Chicago has a fantastic history of architecture, maybe the best in the country. It's very impressive. And IIT was where some of the key members of the Bauhaus from Germany fled after World War II. The school itself, the Architecture and Design Institute, was designed by Mies van der Rohe. So there's a very significant history there, and a lot of connection to modernist, mid-century modern design in Chicago. So there's a lot of exposure to that. And my work has always tended, my artwork has always tended to be more architectural in nature, and I've always been inspired by architecture and architectural spaces, and also the combination between art and architecture. And the integration of the two to create spaces and places. So how does that connect to my involvement in architecture? Should I jump into that? So
yeah, and also on the it's a really interesting story. In terms of even development, like to be a developer and develop something from the ground up, like it requires a pretty special person and a special passions around it, because there's like, if you were in the investment space alone, me myself, the most I've ever done is doing a repositioning of a building, let's say. And there's like a lot of risks involved with it, that sort of thing. And it takes a very, very long-term vision. So I'm just curious about, like, is there like sort of a nexus of all those things that kind of come together from where you come from?
I think that's really a great question, because this is one of the things that happens in doing this. You're really pointing it out, is that there's so many challenges along the way. How do you stay focused on where you're trying to get to? And I think for most people, where that's not kind of inherently in what they're about, it's easy for those things to get lost or pushed to the side, or just you're focused on the challenges and the problems, and then things needed to happen and they didn't happen, but now you kind of can move it forward, a project forward, and then things just get kind of lost gradually. And I think that this has just generally been a problem with a lot of projects. So because it's more ingrained in where my vision is, I'm always I'm always focused on it. Focused on what the outcome is, but it's definitely challenging when you're dealing with a lot of the problems in the process, and there's a lot of challenges, as you pointed out. So how do you stay focused on that end point? You've just got to really stay true to your vision and what you're hoping to achieve with a project, and also know that if you do, that's really what's going to put the end point of your project in the right position. If you can really take the risk to take some design, put some real design effort and design thinking into your project, the project in the end will be more successful. So it's understanding that, where you're trying to get to in the end, and making sure you don't sacrifice it, because if you do, you're going to also sacrifice your exit numbers.
Yeah.
And that's what's hard for people to focus on, because it's not so easy if that's not ingrained into your thinking, to understand, what is it that I need to do? What do I need to stay focused on so that, I can really elevate the product in the end? And it's not always let's spend more money on, really nice marble for the kitchen counters, or pay more money for appliances. That's not really, it's not always required. That's helpful if you're in the right context and the right project, but you don't necessarily need to do that. It's more of a thoughtfulness in the process, in understanding, what you're trying to build and where you're trying to get to, and that will be evident in the end. And then you get things like, I've built a project where there was so much interest in the building. It was held as a rental. People would randomly call me up and ask if there were any available apartments. Just, they would look up, and I would figure out how to find my number and just call me. Like, I was by your building. I just, are there any apartments available? I really love it. Or in multiple times I've rented apartments in 5 minutes or less. And it wasn't because they were priced inexpensively. I'm not 20% below market and it's an incredible deal. No, I'm at market or above market. And because people love what they're looking at, there's just that kind of demand for it. So if you can stay focused on that, knowing that can be the result, that's how you get there.
Yeah, it's really difficult to quantify, because I think that I've been guilty of it myself, where the first place we're going to sacrifice is on design, because we're getting, the tail that wags the dog for us is like rent comps, let's say, right? So we're looking at, all right, well, these are the rent comps out there for similar product. What's that margin of difference in terms of where we could push our product at a premium to that? And how is that calculated, right? So it's almost like, it definitely requires a certain amount of like, what, I think we're going to be able to get it. Yeah, we're going to do it because it's going to be that much better. That's something that I struggle with myself.
Well, I think for rental projects, one of the differences is just, what level of vacancy that you have. If you're going to calculate a 5 to 7% vacancy in your project, if you take that down to 1%, and look at your underwriting, it's going to bump up that bottom line number significantly, because that's all just going to come off the top, right? That's what you're going to get. You're going to pocket that difference. So it's not it's 5% of the total NOI, but that 5% is what's coming to you. So it's much more of that in terms of what your return on the investment is. So that's possible, because if people really love the building that you're in, that you own, that they live in, that they're going to stay longer, for one. They're going to tell their friends about it, or their friends are going to come over and they're going to be interested in it. You're going to have great photographs of the building. There's going to be a sense of community around it if it's a larger multifamily, and that will drive that rent vacancy number percentage down. And also, you can get a little bit more money out of the rentals. How much that is, that might be a little bit more difficult to calculate. But if you look at both of those metrics together, then you're really looking at a significant bottom line difference. You have a much lower vacancy percentage, and you have a slightly higher price per unit than the average in the market. Combine both of those together, and that's a great outcome. And how much more did it cost? And then also, if you're looking to sell the property in the end, if you've got a better property, you're going to do better on the exit as well.
Yeah.
You're going to get more interest. It's going to take less time to sell it. You generate more interest. I mean, Mark, you know this as well as anyone. If you can drive interest into a listing, right, that just, people might bid it up, or you get offers more quickly. You can compete. You can shop those offers around to other interested parties. But if if the listing sits on the market for 90, 120, 180 days, you're certainly not going to have a bidding war at that point.
Right.
You're going to hope you get a bid.
Yeah.
I love it.
So all of those things can play a role if we're just looking at the numbers, right? But I think it's more than just the numbers. It's the numbers for us as investors, right? But what it also plays into, what design also plays into, is the real experience of your end user, right? I mean, if we're doing large multifamilies, smaller 2 or 3, 4 families, single family. There's an end user there always. If it's a multifamily, sure, you might sell the whole building to another investor, but the numbers are going to be driven by the end user, the renters. So if you get higher numbers from your renters, then that's going to really affect your cap rate. But those numbers are going to be evident because people like where they're living. They're attracted to it. It makes them feel good. There's that quality to it. This is just, there's that in marketing and sales, there's that, often quoted phrase, which I believe was originated by Leo Burnett, also from Chicago. He started a big advertising firm, that, people buy emotionally and they justify it intellectually.
Yeah.
So if you walk into, when you come up to a building, I mean, there's always a discussion, curb appeal. But if you have that kind of curb appeal, and then you also enter the property, whatever type of asset class it is, and it takes you beyond that curb appeal, it continues inside. So you're already, you already like what you're seeing before you walk in the door, and then you walk in the door and the experience continues. You're going to have an emotional response to it. And I think pretty much everyone out there, if they find a property that makes them feel really good and feel happy, will probably pay a little bit more money for it, because how much is your happiness worth?
Right. What do you think?
Pay more for it.
What do you think the ratio is on, like you said, curb appeal and elevation versus interior, fixtures, finishes, layouts? Do you think they're equally important? Do you think that's, if you got a really killer interior, you can kind of be a little bit lax on the exterior? Or are you saying, no, you really got to pay attention to the elevation. You really got to pay attention to the curb appeal in order to get that premium?
I think it's about the consistency of the entire building, that, and that's where, really understanding design takes you to that next level. Like, the whole thing should have a complete feeling to it. Whether it's, a mid-market product that's just better designed and is better positioned in that market, or if it's a luxury product, that the whole product itself, the whole building should have the same quality. With good design, there's consistency with all the elements, and they all work together. So that should really be the goal. And there's definitely buildings out there that just would cost too much money to upgrade and really improve in the right way. We have a lot of buildings that, I mean, you can argue different ways. We have a housing shortage, so should they all be demolished or not? I don't know. People need some place to live, but there's a lot of buildings that just they can't really be fixed. They're beyond, because they just the bones aren't there. So there's definitely, I think, from on the buy side, these are definitely things to look at. Can you take the asset and really improve it, based on how much money you want to put into it, and elevate it, again, in whatever asset class you're in whatever segment of the market that you're in.
And how do you find the right general contractor to fulfill your vision?
That's a good question, and it's a challenging question. I think I think for a lot of people that can be difficult. I have a little bit different background. As I mentioned, one of the first jobs I ever had was working for a general contractor. I've worked in capacities where I've done most of the trades myself. And I've done a lot of manufacturing and designing of pretty high-end types of fixtures and decorative art objects. So I have a keen eye for detail. I think for some people it drives them crazy. But I can look at someone's work and actually see, I'll go and visit a contractor's projects. Of course, you need to vet them. But I can see what's going on just based on experience. So what I would recommend for someone that doesn't have that level of experience when vetting a contractor is find a friend or someone that they know that has done similar work or has knowledge of construction. Bring them along, take them out to dinner, or pay them something, and so you can get a little bit more feedback. Like, you might think the end product looks great, but your friend or colleague might say, well, I looked at the mechanical room and I don't know.
Mhm.
The kitchen looks okay, but this might cost you a lot of money in a couple of years. So getting a little bit more feedback and just doing, a little bit more analysis.
Yeah.
And, you also want to look at, it's not just track record of completion. It's, talk to some of the subs too,
Right.
understand what the relationship is, do they have a long-term relationship with specific subs,
Right.
or do they, end up using new subs on every single job? That would be a bad sign to me.
Yeah.
So, things like that. So you want to assess the work, or have someone that can assess it, really take a look at it, and then really understand the relationships that the contractor has, and also, assess their level of experience. And you got to
Yeah.
like them and be able to work with them on top of it. So, it can be challenging depending on what market you're in, because there's still a lot of demand out there.
Yeah. That's really great advice. And then for your firm, do you guys have like a project manager that interfaces with the GC, or is that all on you? Did you hear me?
I might be a little bit frozen.
Oh.
You can see me, right? Oh no.
Oh, he's back. He's back. Give him a sec.
Okay.
Hey, we lost you for a sec.
I thought it was some marker I said. So yeah, Mark, you were talking about, do you have a person that interfaces like a project manager? You said, what was your
Yeah, I was
question,
just
Mark?
curious how that's structured between your firm and the GC firm. You have somebody dedicated that's just full-time, project manager that kind of oversees the general contractor?
That's a good question. So my partner is actually the general contractor. So
Okay.
that was an important component when I had a project that I wanted to start working on. I was looking for a general contractor that I could partner with, because I feel like that's the best way to kind of align things in the right way, so that they have the same incentive to complete the job successfully that I have. Now, not everyone's going to be able to do that, so there's a lot of different ways to think about how to structure a contract with a general contractor. And that would require another LinkedIn Live to go over that. But I
Right.
mean, that's definitely for people that are hiring contractors. Really something to take a look at. And there's different. I mean, I know you guys have both done it, but there's different ways of looking at contractual structuring, and then it's also based on kind of size of project, and then that also kind of goes into the architectural component of it, and there's some layers involved with that as well, with actual contracts that the AIA has produced in terms of creating the relationship. So we could spend quite a few hours kind of digging into it, but I think a half an hour would be good. So yeah, and something that just makes sense for people who are getting into those projects to just get a little bit of education about.
Yeah, for sure.
Yeah. So I have a question. Switching gears a little bit here. Mark and I are in the capital raising space. Just curious, what does your capital stack look like in terms of the projects that you do? Are you out there raising money or what?
Yeah, that's a very good question. And definitely, thinking about capital stack for development projects, is really something I think that's pretty valuable to discuss. Like, how do you capitalize a development project? What does that look like, and how do you make it work? How do you even get into it in the first place? Where do you start? I think a lot of these things are just mysteries to people, and they don't even know how to think about it, right? Like, it seems so daunting. But as with anything, if you break it down into the steps, you can at least understand how it works, and then you can make decisions if you can kind of move forward with it. I mean, the typical capital stack, if the project is syndicated, right? Let's say it's a larger project, it's going to be either syndicated, or you're going to have a couple of components to your capital stack. You would have 3 or 4 pieces to that stack. The biggest one being the senior loan, which is your construction loan, and that would, let's say, out of the total, I would not like to see that leverage more than 70%. It's probably not possible at the moment in the current capital markets to leverage it more than 70%, but at various points it is possible. And if you're doing a fix and flip, or even a super heavy rehab, there are lenders that will lend more than that. So there's some, I would just caution people to be, considerate of their leverage, because it's a point of risk. So you have that piece. And then, below that, you're going to have, if it's a 3-piece capital stack, you'll have either your investors, if you're syndicating it, which would be LP investors, or you might have an institutional partner or a single LP that's bringing in all the money. And then you'll have GP equity. And if you're working as a sponsor with that kind of structure, you want to have at least 10% GP equity in the deal. And that can come in some different ways. It doesn't necessarily all have to be out of your own pocket. It just has to be in the deal as GP equity. And if you're newer to the development space, that potentially needs to be higher, depending on where that other piece, the one that's above your GP equity, because that's going to be the smallest piece, where that's coming from. If you're working with an institutional partner or a single LP, for less experienced operators, they might want to see 15 or 20% GP equity in the deal. So that's the 3 pieces: senior loan, institutional or LP equity, and GP equity. 4 pieces would be the senior loan, and this is a very common stack right now: senior loan, preferred equity, then your LP equity, and then your GP equity. So the preferred equity has become a little bit more common, particularly right now with the way the capital markets are at, because the senior loan is the leverage on the senior loan has shrunk. So maybe you could have gotten, for new construction, 75% or even 80%, which again, I would say is probably a little bit too high, but you could do it. But now, particularly in the last 12 months, maybe that shrunk down to 65%. So that's a considerable difference, 65 to 80%. So how do you fill in that space? And there's been a lot of preferred equity players out in the market that are willing to kind of fill that in, obviously for the right return, which is not a low return. I've seen quotes for preferred equity ranging right now, particularly for new construction, between the high teens, and actually someone quoted me something that was going to look like closer to 30%. So that seemed a little excessive. Not something that I would jump into, but I've heard other rates that are closer to what an LP would make. So again, depending on where you're at in the space, and then trying to fill that in. So the larger project that we're currently working on is syndicated, and we've taken a slightly different approach to it, but we have a higher percentage of GP equity in the project, and then there's investor LP equity, and then we'll get the senior loan on the project when we're ready to start building.
And then for the senior loan, is that through the GP, or are you using like a KP?
We would do it through the GP, but the senior loan is actually, we could dig into that for a moment as well, because there's typically questions about a senior loan for a construction project. And again, we're in a different market right now. The kind of loans that we're looking at would be, alternate lender loans, or sometimes called hard money loans, that have a much higher interest rate. Right now, people I'm talking to, they're being quoted at 11+%, maybe 10.5%. Somewhere in that range. There's some points, there's some cost to it, but the money flows a little bit more easily, and the leverage is higher. So it makes development projects, it kind of greases the wheel, it gets you moving better, and they tend to, the draw schedule is a lot, the process is easier. So there's some cost benefit to that. Certainly for much bigger projects, most developers would go to banks that they have relationships with, and they'll get a lower interest loan, but the leverage is going to be lower. And right now the leverage is really been pushed down on bank loans. I mean, I don't know if we keep going in the same direction, maybe there won't be any construction loans from regional banks in a few weeks. Right. Hopefully we don't get that far. Yeah, it's not looking pretty out there. But interestingly enough, in contrast with that, there's still a lot of alternate capital out there. It's incredible. I talked to someone just in the last week who said they had a fund with $2 billion in it that they're lending from. Another alternate lender, they said their fund is $300+ million. So there's a lot of capital out there in that space, and it's just a different space. So it's one, I would recommend people that are doing projects like this to develop some relationships with those types of lenders, because they can really get projects moving. And a lot of them, do fix and flips or value add, even if it's a 2-family, 3-family, can be a good place to start. And you can get a lot of leverage on them also.
Yeah. And how do you find
I've
those?
probably done both of those.
Yeah. How are you finding those types of lenders? Through LinkedIn or?
They seem to be all over the place, actually.
Yeah.
I meet different people, and I've got, a number of brokers that I've known for a long time. But, when you close on a property, people call you. Like, they will actually, in New York, your phone will ring, or someone will connect with you through LinkedIn, or, one of the people I just mentioned, I met at a networking event last weekend, and they have a little different platform. It's actually, it's a pretty interesting platform that they do. So, there's equity out there, and, it's definitely possible to find. I mean, not equity, there's debt out there that you can find. The debt is a lot easier to find. It's the equity that's definitely more challenging, because the debt is secured against the property, whereas the equity is not.
Why are they willing to increase their loan to value ratios more so? Why are they being less conservative
Than banks?
Yeah.
Well, I mean, for a new construction loan, you don't start off at 100%. You gradually move into it. You're taking draws, and there's a way that the loan would be structured so that the construction is always ahead of where the draws are at. So the value of the building is being built, and it's consistent with the value of the money that you're receiving. In addition, there's also the value of the land, and they're not lending 100% on the value of the land. So there's, for a senior lender, there's a good amount of security. It's not the same security with the completed asset. So, there's a track record question and a contracting questions that come up. But, for the most part, in every stage, there's going to be some level of security in terms of, what's being built. And so that's where there's a little more comfort in doing a little bit more leverage. Because you've got the asset, and then you've got the construction that's happening. Banks, it's just it's very different. It's a completely different structure with a, bank construction loan. I've actually never gotten a bank construction loan. So I've looked into them, but they're difficult, complicated, and then they're not as easy to get the draws. Actually, I take that back. One of the projects that was kind of a bank, they're not in business anymore. So, I mean, it was so bad. It's just a little story that, we were a little bit more than halfway through the project, and the bank, or the lender we were with, they had partnered with a lender in Illinois, mostly in Chicago. Why is everything coming back to Chicago? But, I'm in the gym one morning, and I'm looking at the television. It was 2009 or something, right? There had been some banks that were collapsing, and I see this news report about this bank in Illinois that was getting taken over by the FDIC. And of course, it was the bank that had partnered with the local bank that I was with on my construction loan. But what was very unique at that moment was that they actually weren't taken over by the FDIC because the bank had failed. They were caught in this corruption scandal because they had given some donations to politicians that they shouldn't have been doing. So that actually shut down. It was like, you think, okay, it's bad loans, but actually in this case, it was something else. And that was a very, very problematic situation. Yeah. And fortunately, our contractor was able to complete the project, and we owed him a lot of money at the end. He kind of dug into his pocket in some way. Wow. And worked his great guy, really terrific. And he's an excellent contractor also. A lot of my price point right now, but excellent person. Yeah. So, things happen. You got to be ready for some excitement.
Yeah, absolutely. I don't know. You're either crushing it or getting crushed, right?
Well, you never know what will happen. Right?
So I have a little follow-up question then on the subject of contractor. What's your arrangement with your contractor partner? Do they sweat their overhead and profit into the deal?
Yes.
As equity?
Yes. With a small management fee, just to cover some of their internal costs. But that's the arrangement. So that, that really puts us in the right position, so that we're both aligned kind of moving forward. And, you know, for other people out there, they can find a project that makes sense, you know, that it's something worth asking contractors also. I mean, even if it's a potentially smaller project, it depends on, you know, where you're at with the underwriting. You know, maybe you're doing even just a fix and flip. If it's a few units, you know, you might ask the contractor, you know, is this something you'd be willing to partner on? They won't necessarily have to put any money in, but then, you know, you work out some arrangement where, you know, there's some potential upside for them on the back end, or maybe that's built into the contractual arrangement that, you know, part of the performance of the project, the financial performance is tied to their compensation. You know, I think it's an interesting conversation to have with a contractor, because it will help identify people that may be more aligned with, you know, your goals and objectives. Because if
Yeah.
you're someone that says the complete opposite, like, no, I never do that, you know, and they start going the other way, then maybe that's the contractor that's not going to show up when you need them to show up.
Mm-hmm. Yeah, no, it's something I've been contemplating. I mean, I own a 3-story, 16,000 square foot historic building. It was an old bubblegum factory. I've had 2 large tenants that have that have blown up, basically. So we're back at square one with this thing, and I'm like, oh, I you know, maybe we should do a residential conversion on it. But I'd really like to have that, you know, sort of hand in glove feeling of working in, you know, in tandem with a general contractor. So that's something that we've been, you know, kicking around.
I mean, that sounds like a project based on the size and what's possible with it that is certainly worth looking into.
Yeah. Plus, I mean, the total project cost would be below $5 million, so we get that bonus on the New York State portion of the historic tax credits. So it's definitely something we're seriously considering.
I would definitely, you know, approach some contractors and, you know, have that conversation and just see where it leads.
Mm-hmm.
You know, I mean, I would ask every contractor, you know, if you can build it into the underwriting and it works, you know, ask them all. And then, you know, you're going to obviously need a construction loan for the project. So, you know, if you're going for a construction loan and you have a general contractor on the team, that's going to help you with that also. So there's some other benefits. So, you know, it's worth having the conversation and see, you know, is it necessary? Does it make it work? Does it help your numbers? You know, who's the right fit? It's often the more questions you ask will get you to the point where you get the right outcome.
Mm-hmm.
Yeah, very cool. So what about the 70X? I know.
Oh yeah. That's interesting. So, you know, I started with this apartment that I purchased, and that was the 70X. I mean, it's crazy how this can work, right? So, you know, I'll give you the numbers, right? So I was looking for an apartment to rent in downtown Jersey City, which is an incredibly hot market right now. It's I've seen some articles that actually have indicated that it's the most expensive market in you know, it's often like somewhat considered affiliated with New York City. Of course, it's its own place, but the most expensive neighborhood, right? Just by average, not the most expensive apartments, of course. At the time, it was nowhere near that. So, you know, so the price for the apartment that I purchased was $79,000. Sounds pretty cheap, right? I thought it was cheap then when I bought it, in fact. And just as a little caveat, you know, interest rates were not incredibly low at the time. I mean, actually, it seemed like they were low in relation to where they had been, but, you know, compared to rates recently, they weren't that low. I ended up getting a loan with a special rate that was 6.25. That's where I started on it. And I thought it was an absolutely fantastic interest rate. I was incredibly happy with it. So it just shows, you know, where the perspective is. So I ended up adding a little bit of money to the sale, to the mortgage, to cover closing costs. And, you know, and I walked out of the closing, and I basically had put around $5,000 into the apartment, into the purchase. That's it. And the apartment had already been renovated, and it was renovated pretty well. You know, it was partly what appealed to me. So I ended up I really didn't put very much money into the apartment over time. I lived there for a little while myself, and I rented it out for many years. And that's one of the apartments that I rented multiple times for, in, you know, easily under an hour, but in a couple of cases under 5 minutes. People just come in and they want it. It was amazing at really pretty good numbers. And then the last tenant that I had, when I signed the lease with her, she said, look, if you're interested in selling it at some point, I'd be interested in buying it. So I ended up selling it to her with no broker. And the sale price was around $420,000. It was,
Wow.
you know, I held it for a long time, but I was getting great rent while I was renting it. And, you know, it was kind of time to move on from it, because it, you know, just, you know, $1,000 a month I was pocketing wasn't overall, you know, it's not nothing, but, you know, the capital, basically the equity that was in it I felt like could be better served. So if you look at that, you know, the purchase price was 79, right? But the cash in was $5,000. I mean, this is something that's really important for people to think about when they're looking at, you know, a property, thinking about house hacking or things like that, right? That was my out-of-pocket cost. And then I have debt on it. And that debt is really what makes you a lot of money, right? So initially it wasn't that much debt. You know, my debt increased because I kept pulling money out of the property. So $5,000 in, you know, about $420,000 out. Even if you subtract the actual purchase price, it's a little hard for me to do. It's 5,000 to that difference between about 80 and 420.
Mm-hmm.
So like 5,000 turned into that difference, right?
340.
$340,000. Now it took a while for it to do it, but at the same time, I lived in it, you know, and I paid less money than I would have if I was renting somewhere. I pulled money out of it, and it allowed me to invest in other properties, like every other property that I was investing in, and I took money out of it. You know, I refinanced it multiple times. I had HELOCs on it. You know, even paying for all of that, I was still paying less than I would have in rent. And I was using the equity for other purposes, which I hadn't paid taxes on at that time. So I pulled the equity out. I'm using that equity for other investments, tax-free, essentially, and making, you know, allowing that money to grow also. And so this is how, you know, it starts to snowball. So with that $5,000 investment, you know, it traveled up into the hundreds of thousands. You know, it's hard to calculate. I'd have to sit down and look at where it all went. You know, it might have even gone higher than that. But, you know, if you can just put together enough money to get started somewhere, which doesn't have to be that much, you know, I think less than a lot of people think, and make sure you have good credit.
Yeah. My first property was $7,000 out of pocket. So I'm right there with you.
Right.
I have not sold it. I'm a hodler.
Yeah. I feel like one of my mistakes is that I've held properties too long.
Yeah.
That's why I'm not holding anything. I want to build in stuff. But, you know, there's kind of a sweet spot, right? I mean, the industry standard is around 5 years. But I've held property for longer than that. But, you know, that's how you do it. You got to, you know, start somewhere, and there will be appreciation. Of course, you know, I would say I got lucky because that was a location that really appreciated quickly. And it was at the point where the city was in general appreciating quickly. But there are other places that will appreciate. And I think one of the mistakes that a lot of people make is they're waiting for the right moment to buy something. Right. And I'm sure you know, you both have seen the same thing, right? Maybe you've even had some clients that you've worked with on the brokerage side where, you know, you've been showing them houses for a year or two and they still haven't found one that they wanted to buy. Like, just pick one, you know, there's not a perfect one out there. I mean, I've known people too, they looked for years, and in that period of time that they were looking, they had enough money to buy, and they might have even priced themselves out of the market. They couldn't buy the same thing 2 years later. And they missed out on all that appreciation. Yeah. So, you know, you can't hesitate, and maybe you get the best one, or maybe you don't, but, you know, if you don't make the decision, then, you know, that's really what will short circuit the process.
Yeah. And so I tell clients, you know, do you think the prices are going up, down, or staying the same? You know, if you think they're going up, then your delay is just costing you money.
Yeah, absolutely. But even if it's flat or it seems like it's going down a little bit, you know, I mean, it depends on what your motive and your purpose is and how you're looking at it. You know, you can still buy properties in a declining market that have reasonable rental income. And again, if it's a house hack situation with 2 units, you know, you can do a little, you know, a little renovation, light renovation on the rental unit and get a little bit better rental income. I mean, right now, I think it's actually a reasonable time to think about that because, oh, it seems like interest rates are higher. So if you can find something and, you know, there's going to be there's still buyers out there, obviously, but there'll be fewer buyers out there, possibly get something at a, you know, reasonable price. Obviously prices have gone up, but you get in with a higher interest rate loan, you know, refinance it. The rates are going to come down. You know, how much do they come down? You know, that's a different discussion, but they're probably going to come down. I think everyone's in agreement there, just to depend on how long. So you get in, you refinance it. Maybe when you refinance it, you can pull out 20 or 40,000, or you could potentially just get a, you know, a HELOC on it if you're still living there and you've got that, you know, rental income. And then, you know, that can allow you to move into something else much more easily.
Yeah. Very cool. Any final thoughts? We're at 3:01, so we should probably wrap it up. Matt, you got any final questions?
No, I mean, I always have tons of questions afterwards, but you know, it was like we don't want to keep beating the horses out here, but no, I'd love to connect with you, Aaron, if you're open to it.
Yeah, I mean, I think that project that you're just describing, like, that sounds like a really terrific type of, you know, conversion project. And, you know, where, you know, if you think about the design of the project in the right way, that could, you know, significantly drive the value of the project. And there's a lot of different ways to do that kind of conversion, and it's not always done the best way.
Mm-hmm.
So, you know, there's some things to think about that could, you know, really dramatically improve the end result. And it's not all tied to how much you spend on it. Some of it is, some of it isn't. But, you know, that starts to be an interesting, juicy project to look at, you know, just, you know, from a real estate standpoint, you know, throw in the design component to it, the historic component to it, right? Lots of excitement, I think.
Yeah, absolutely.
Cool. Well, thanks everybody for joining us on this LinkedIn Live, and we will see you next Thursday at 2:00. All right.
Thank you. Thank you both, Mark and Matt. Really enjoyed it.
Take care. Peace.